This presentation focuses on the financial analysis of two discount companies, Dollar General versus Dollar Tree. The first thing we're going to look at are the shareholders of both companies. Van Group Incorporation is a top shareholder for both discount stores. They hold about 6% of total shares. Next is State Street Corporation, which holds about 4% in each company. The two corporations also share other investors such as BlackRock and FMR.
Investors should care about the cost of capital because it determines the efficiency of how a company uses its funds in a business sense. If they have a favorable cost of capital, then that means that the company is maximizing their sources of funds and therefore stretching every dollar for the investor. This truly means that the investor is getting the biggest bang for each buck invested in the company. In an opposing view, if the corporation has an unfavorable cost of capital, then they may shift their sources of funding from equity to debt, since historically speaking, it is cheaper, thus investments would be more volatile and risky. There are many advantages to debt financing, such as share of ownership, tax deductions, and interest rates. The advantage of a share of ownership means if you are financing a greater amount of your company through debt, then you're giving less ownership to equity financing, so to other shareholders. For tax deduction purposes, the interest paid back on debt financing can be tax deductible, whereas equity financing, there is double taxation for investors, so it's not beneficial. The advantages of debt financing is the lack or the interest rates that you would be getting would be set instead of equity financing where you would have to pay dividends and various other costs on a yearly basis, whereas interest rates are locked in and you know exactly how much you're going to pay. The disadvantages of debt financing, however, for repayment interest rates, the need for good credit and collateral are all should be in the same category. If you do take out a loan or funding for your business, then at some point in time you have to pay it back. There are interest rates accounted for that you will have to pay. You would need solid credit and possibly collateral in some shape or form of your business. Secondly, there's bankruptcy issues to be resolved, whereas if a company is heavily in debt, then there's a greater percentage, historically speaking, to go bankrupt. Lastly, there's agency costs that the company has to face. Taking a look at the optimal structure of Dollar General and Dollar Tree, something was really evident. According to the charts downloaded, both companies would have an optimal debt ratio of 90%. This was really alarming from the beginning. Both companies don't have much invested in debt, but with the optimum debt structure to 90%, both companies would greatly benefit. All in all, the most favorable optimal capital structure is that of Dollar General. Although their optimal debt ratio would be 6% higher than their competitor, the company and shareholders could potentially increase their value per share by $1.70, whereas Dollar Tree wouldn't even break a dollar increase. The enterprise price value would grow for Dollar General by $500 million as to Dollar Tree's $88 million. Dollar General would more greatly benefit from the shift to the optimal debt structure because of the larger increase to the price of the stock and the increased enterprise value.
Cost of debt is very important for investors because it helps them determine how risky a company is. Usually, investors are more attracted to companies that have a lower cost of debt. Here we calculated the pre-tax cost of debt and the after-tax cost of debt. To calculate the pre-tax cost of debt, we add the risk-free rate to the spread value. Dollar General has a spread value of 1.75% based on their rating. Dollar Tree has a value of 3.25% based on their rating. After we do the calculations, you can see that Dollar General has a pre-tax cost of debt of 4.75%, and Dollar Tree has a cost of debt of 6.25%. Based on these calculations, Dollar General is more attractive to investors. Then we calculate the after-tax cost of debt. Here you can see that Dollar General has a lower cost of debt than Dollar Tree, which again makes Dollar General more attractive to investors.
Taking a look at the cost of equity financing, we came up with 3 betas for each company. First, we got a data for both companies by taking a 5-year monthly average against the S&P 500. Next, we looked at the Stern NYU EDU page, and through the chart and tools listed on the website, we were able to come up with a different beta. And lastly, we went on moneymsn.com and various other websites not listed to come up with an average for the betas for both companies. So finally, we were able to come up with the cost of equity calculation for both companies by taking the average of those 3 betas and inputting it into the equation. We got the risk-free rate from the 10-year T-bond rate from the U.S. Department of Treasury on February 10th, 2015. All in all, taking a look at both companies' cost of capital, it's really the choice of the investor which one is better. A stable, predictable company will have a low cost of capital, while a high-risky company with unpredictable cash flows will have a higher cost of capital. Both of them are very close for Dollar General and Dollar Tree. For our sake, we prefer Dollar General for the investor's point of view. Having a company with relatively the same amount of cost of capital, this means that you would be getting a higher reward for the amount invested into the company. Here, we have the overall cost of capital that we calculated out for both companies. Something that's very interesting is that both companies have an equal amount of weighted cost of capital. Therefore, since both companies are equal, this decision as far as the cost of capital is even. Next, is it possible to lower the cost of capital by having an optimal capital structure? Yes. Taking a look, it is possible for both companies to lower their weighted average cost of capital. For an optimum level, the company that would see the largest decrease would be that of Dollar Tree. To do this, however, both companies would have to move their debt ratio to 90%. So all in all, the favorable one to lower the capital structure is that of Dollar Tree, because as seen, it would take a less amount of change, 50%, to its debt ratio as compared to Dollar General's 56%, to have a greater change. Restructuring the financial structure of both companies would affect the value for each respective company. From the analysis listed beforehand, Dollar General would make a shift from 33.72% from its debt ratio to that of 90%. This would lead to an increase of the overall value of the company from $8.15 billion to that of $8.66 billion, a total increase of over $500,000. Dollar Tree would also see a large gain in the debt ratio from its current 39.28% to an equally large 90%. This would increase the value of the corporation from 1.92 billion to 2.01 billion, an increase of only 88 million. Therefore, while calculating it out, Dollar General would have a greater impact to the value of the company by having an increase of 6% as opposed to Dollar Tree's 4.5%. Evidently, both Dollar General and Dollar Tree are well below the optimum level of debt. Increasing their current levels to optimum would lead to some benefits, such as increased value and stock share, but there would also be some disadvantages. Some advantages include the tax savings for the corporation. Debt financing does not have government taxation like dividends and earnings. Instead, the interest paid takes the form of tax savings for the corporation. The analysis does show an increase in the value of the firm and the share price of each stock. Furthermore, the beta would greatly increase, grabbing the attention to those that want to score big, making the company more tradable. Some disadvantages, however, are a handful. First, there's the risk of default. With so much debt for a corporation, it is no wonder that some of the biggest companies to date have needed bailouts because they were not able to pay back debts from crashing companies. As stated before, there would be an increase in agency costs and management risk and an internal struggle for ownership of the company. There would be a decrease in the flexibility as a lot of the company's funds would be tied up. Lastly, there would be a risk of bankruptcy. With so much debt, there is a possibility of a company going under. So concluding, both companies would face a necessary risk when changing the cost of capital. Dollar General and Dollar Tree would both face interest rate risk, default risk, credit risk, reinvestment risk, and lastly, liquidity risk.
What does a competition do? Family Dollar is a company within the same industry that's a good competitor for both Dollar Tree and Dollar General. When we take a look at assets, we can see that Dollar General has a higher percentage in long-term assets, while Dollar Tree and Family Dollar hold higher weight on their current assets and cash. When taking a look at liabilities, both Dollar Tree and Dollar General hold the same amount of weight in long-term liabilities. However, Dollar General does hold a lower percentage of current liabilities. When we take a look at shareholder equity, we can see that all three discount companies hold about the same weight.
Lastly, both stocks are fairly priced. Looking at the PE ratios and the EPS ratios, both stocks are very close to what their actual prices. This information was received from Yahoo Finance on February 15th. In all, our decision is concise. We would invest in Dollar General as it is more attractive to investors because of its low cost of debt, its low cost of equity, its lower potential WACC, and its higher potential growth according to optimum levels. Thank you.